market interaction, we'll be talking to a market persona who is not new to the markets, but the only new thing that has happened to him is he has opened his new firm. I'm talking about Saurabh Mukherjea, founder of Marcellus Investments. Thank you so much, Saurabh, for joining Mantika Markets.
My pleasure.
So first of all, if you can just take us through this word, Marcellus.
Right.
What is the main objective behind selecting this, and what do you intend to achieve going forward?
Right. So look, when I was looking for a name for the firm, I knew that we would be called investment managers, but I thought, let me look for a person I have idolized, a person who's one of my heroes. And Muhammad Ali's name came to my mind. It's one of my childhood heroes. Muhammad Ali, before he became Muhammad Ali, was called Cassius Marcellus Clay.
All right. Okay.
And Marcellus means little warrior. So, so Marcellus itself has a resonant meaning, and it's the name of a hero, and hence I decided my firm will be called Marcellus Investment Managers.
And we hope that your little warrior theme will turn out to be a big beneficial for investments going forward as well.
Absolutely.
Sure. As we're talking about, the intention is to talk about Indian markets and road ahead. The macros, as we're talking about, as we speak, the rupee is already at 71 odd levels. The larger concerns of the depreciation, 11 odd % YTD, the broad-based weakness is rupee is also fueled by the oil thing, which is also trending or suggesting something else. So what's the intention behind it, and are you worried about it in terms of macros?
Sure. As any credible economist will tell you, Manoj, it's very hard to forecast the rupee. But that being said, I was convinced 8-9 months ago that the rupee was set for a major fall, and I went around both in my research and in my TV appearances saying that the rupee was set for a major fall. The reason being is this was pretty simple. If you look back at the post 91 era, the rupee is depreciated by around 4% per annum.
Right.
However, since August 2013, the rupee had been very stable, right? And if for 5 years the rupee is stable, you know pressure is building up on the currency. So accumulated depreciation of around 25%, of depreciationary pressures of 25% is built up. And you could see our exporters were getting priced out of export markets, our imports were rising. So I think a correction in the rupee was long overdue for a long time actually. And even now, I'm not so sure 71 is the right level. I think it's highly likely the rupee will continue sliding further, not just because of oil prices, that's a part of the problem, but I think leaving aside oil, because the domestic economy is steaming along, we're importing lots of electronic items, lots of cars, car parts. So all this electronics that we see, your camera, etc., it's all part of the current account deficit. And as the economy booms, I think our current account deficit will rise further, putting further pressure on the rupee. So one shouldn't rule out 75 to the dollar over the next 12-month horizon.
All right. So as we're talking about this, but even though the rupee has fallen to 71, the bond yields are suggesting something else. So it's 10-year bond yield is trading close to around 7.9%. So it's all been factored in. What do you think? So will be the trajectory of bonds going forward if the rupee, as you suggest, is slated to trade close to 75?
So I think the bond yields have sort of two different forces bearing down upon them. One is sort of fiscal slippage, as several rating agencies have said. It looks reasonably clear that in the year to March 19, the government will miss its budget deficit target. The rise in oil prices obviously has only partial bearing. Remember, petrol and diesel is by and large now freely priced in the market. It's only kerosene and fertilizer that contributes a little bit to the deficit. So the bond yields largely are reflecting election-related spending, pushing the budget deficit up this year, and some shortfall in GST revenues. What I think is not yet in the equation, I don't think is in the equation, is if in the last 4-5 months prior to the election, the government sharply accelerates spending on social subsidies, loan waivers, loan forgiveness, I think there could be a further rise in the 10-year bond yield. So I think the 10-year bond yield has gone up 140, 150 bips in the last 12-13 months. I don't think, I think 8%. 8% is not an unlikely number for the 10-year bond yield to reach. I think when the NDA took power, the 10-year bond yield was 8.7, 8.8. So for over a 5-year duration, it's gone from 8.8 to 8. That's a reasonably good achievement on their part.
So as of now, one more rate hike is factored in?
I don't know, how much the RBI will hike, but my reading is given the rising inflationary pressures, both because of rising commodity costs, but also because of election-related inflationary pressures.
Exactly. Fiscal concerns, rupee, oil, as you suggested.
So 2 rate hikes before the election, I think, is my base case scenario. 2 rate hikes before the general election.
One more quick question on that. As you say that rupee 75 is not ruled out. If the oil trajectory is above 80, what will be the RBI stance going forward? As you say that 2 more rate hikes are there, what should be the retail investors' mindset
I
going
think
forward?
both Delhi and Bombay have made their point of view pretty clear. Niti Aayog has repeatedly said that they want to see the currency continue to slide. Rajiv Kumar has been very vocal in saying that he wants to see the currency depreciate.
Sure.
And the RBI has shown through its actions that it's barely interfering in the rupee slide. So it's not evident to me at all that the RBI will stem the slide of the rupee. And as we've discussed, it's not a bad thing. The currency had got overvalued.
Exactly.
Our exporters were getting hammered, and therefore the fair value of the rupee is anywhere between 75 to 80, I would say.
All right. So as we are talking about macros, and this is something which we have not seen for last say maybe 6-7 years, is micros are improving, and macros there is a concern. So I'm talking about earnings. What are you doing in your portfolio? If you can just suggest that.
So look, I think on the earnings recovery front, as expected, this looks likely to be the first year in 5 years where the Nifty generates double-digit earnings growth, right? So that's a good thing. And as expected, as the economy picks up and inflationary pressures pick up, operating margin pressures are increasing for firms. And you can see this clearly in auto companies, manufacturing companies' results,
Right.
and even in lenders' as results. NIMs are getting compressed for the lenders as the cost of wholesale money goes up. So my portfolio has two parts to it. One is a structural part of the portfolio where I buy high quality names and I don't do much with it, very similar to the coffee can portfolio.
Alright.
And I remember you are interviewing me for that. So buy great companies, hold them for long periods of time and try to get 10x in 10 years. But the other element of my portfolio is where I believe I have a grip on the macro, say on the exchange rate. I then try to look for companies who benefit
Out of the exchange rate.
Absolutely. So November, December last year, I was very bullish on IT. I think I told publicly whichever TV channel was willing to interview me that you should buy IT stocks. It's had a good run since. I think there's more upside left in IT. I think Pharma is overdue a good run. There was a brutal correction last in Pharma. And similarly, manufactured goods exporters, auto exporters who have a franchise in selling to the West. They too are, I think, overdue a good run.
So that is the rupee theme which you are playing as of now. So
that's
IT,
the
pharma and the auto.
And I stress again, my portfolio is two parts. The structural piece where I only look for great long-term compounders, coffee can type stocks.
Would you like to highlight any stocks on that which
So I think
which is there in the portfolio?
In Unusual Billionaires, the book that was published in 2016, I highlighted half a dozen stocks. The book's gone on to do well, partly because the stocks have done well. And you know, a name which keeps coming back to me every time I have these discussions is Asian Paints. 1983 IPO, up 1500x since the IPO. I've met people who said 25 years ago that they thought Asian Paints was done. I've met people who said 15 years ago they thought it was overvalued. I migrated to India 10 years ago. I met people then saying Asian Paints was overvalued, and at any point in time I always meet people who say Asian Paints to ho gaya, overvalued hai. The company continues to deliver outstanding results. Great franchise. The archetypical coffee can stock, 1500x up since IPO in 1983.
Fantastic. As you're talking about consumption space, and it is quite evident from the results from all those consumption related stocks that the earnings are showing signs of pickup as well as margins as well. So what is the theme going forward? Is this theme is up and the results have been captured into it?
Yeah.
I'm talking about investments have been made and returns are already taken from this segment.
Two things, I think it's worth distinguishing earnings growth in two different ways. If you are someone who's focused on near-term stock market gains, if you're a speculatory type of investor who wants to, make money in the short run, it's not earnings growth per se that you should worry about. It's earnings upside surprise, right? And if you see 1Q, the biggest upside surprise came from Pharma.
Exactly.
Right? If you look at the last 4 quarters, the biggest upside surprise has come from IT. So sectors which go out of fashion and everybody sort of gives up on them have a very strong tendency to generate earnings upside surprise, and I think Pharma, my reckoning is, will continue generating earnings upside surprise. Right? That's the tactical part of my portfolio.
Sure.
However, structurally, there's no point trying to second guess structurally who will surprise. Right?
Perform.
So therefore, you need from a structural perspective, you need companies who can compound earnings at a very healthy rate over a 5-10 year period, right? And that's where firms like Page Industries, like an Asian Paints or an HDFC Bank become so relevant because of stellar long-term compounding track records. So if you're a near-term guy, look and you want earnings surprises, I would say look at pharma as a sector. Long-term compounding, coffee can portfolio is the way to go.
So one quick question: in pharma, should the retail investors start accumulating? Because I believe that there are many retail investors who have stayed away from the pharma from last 2 or 3 years or maybe more than that. Is it the right time? Because as you said that there are early green shoots of earnings picking up. Pharma, yes or no?
So I'm not so sure that retail investors should be doing market timing, right? It's like my watching Olympic gymnast on TV and saying I will also do gymnastics. A retail investor, coffee can portfolios are ideal for them. Buy great companies, sit on them and make 10x in 10 years, right? You want to make money from great stocks. However, if you want to do gymnastics and it's your body and it's your money and you want to do gymnastics and you want to time the macro cycle, then when you believe the macro cycle is going to boom, then play banks, lenders, metals and capital goods.
Sure.
And when you believe the macro will throttle off, growth pe dabav aayega, interest rates will go up, currency will come under pressure, the sectors to look at are IT, pharma, FMCG and parts of the auto sector, the two-wheeler sector actually.
Sure, as we're talking about, as you rightly said that the retail investor shouldn't take a risk of betting on the pharma as of now. But there is one more thing which I wanted to discuss is the profits to the GDP ratio is close to the mean average, maybe a 10-year low. It's trading close to around less than 4%. If is this a sign of positiveness? Because this is down majorly because of the PSU banks earnings, which has not impressed much. So going forward, is there any scope for this to pick up and hence the opportunity? Because we have seen the NBFC basket pool of profits rising from last 1.5 years.
Sure. So two elements to think about there really. Firstly, remember we are I think everybody's agreeing and whoever wasn't will surely agree after 1Q that this will be a year of very healthy earnings growth. There's an economic pickup and earnings growth will be good. But it's also reasonably clear that the market has more than fully baked in that earnings growth pickup, right? So at 22, 23 times forward earnings, it's very difficult to say that the Nifty is cheap, and similarly BSE small and mid cap, by no stretch of the imagination does it look undervalued. So yes, profit to GDP will pick up, earnings growth will pick up, but it's not evident the stock market is due for more upside just because of an incipient earnings growth pickup. The other element of it, which in a way links to your PSU bank point, is it's the remarkable thing to think about is that PSU banks are hammered out of black and blue. In spite of that, Nifty financials accounts for 40% of the Nifty's weightage.
Exactly.
No sector in the history of this country has accounted for such a high weightage of the Nifty, and that's in spite of PSU banks suffering so much. Imagine private sector lenders are accounting for basically 30-35% of the market cap of the country, and that I think is a warning sign. There's a very strong negative correlation between bond yields rising and the bank X pulling back. Another way to look at it is whenever liquidity tightens in America, 2006, 2008, 2013, whenever liquidity tightens in America, in 6 to 7 months the bank X corrects 30-35%. So whichever way you cut it, there is one part of the market, 40% weightage, banking, financial services, which is looking to be in trouble from a macro perspective.
Accumulation in banking sector or NBFCs, anything you wanted to highlight?
So again, someone wants to do structural investing in high quality lenders, absolutely go for it. But if you fancy yourself that you'll be buying Bajaj Finance or AU Finance or Bandhan Bank at these levels and you believe you'll be able to make money on them, then you're a braver person than I am.
So as we're talking about, as we are nearing to the end of this conversation, two sectors that are in concerns as of now is the aviation sector. So is there any thought we would like to put on this sector as well?
So I've always been sort of very intrigued by how people across the world, it's not just in India, people across the world keep buying aviation stocks knowing full well that the passenger doesn't care whether he flies airline A or B. He just needs a cheap ticket from, say, here to Delhi or here to Bangalore, right? And we all now use these things or our phones to buy
the tickets done.
Absolutely. So on the one hand, the same person will use internet price comparison site to get the cheapest ticket to Delhi, and then he will go and buy an airline stock thinking nahi wo wala airline to chalega. So this is a mental kind of confusion I've never understood. That being said, in sectors like airlines, when capacity gets taken out, right, one large airline shuts down, say Kingfisher 5 years ago, or perhaps another airline in the next 6 months, in sectors where capacity gets taken out, that's usually a good time to enter the sector for say a 12-month period, 24-month period, right?
Infra space attracts you or not?
Not really. I've never been a big fan of infra, partly because well-run infra company with great capital allocation have been hard to find. Yes, the government is doing infra capex, but that's more than adequately baked into share prices. So I'm not so sure whether infra, capital goods, banks, that whole piece, whether I should be tactically as well loading up on those. Infra, there's a further concern of other numbers that they report. Are they really true? Or do they sort of make the numbers up sitting down with the auditor?
Sure, real estate is a good idea.
Real estate, buy it for yourself, not a good idea. Office is a different thing, but residential real estate looks overvalued. Buying real estate stocks, different kettle of fish. I think it's clear that the sector is formalizing, right? We have, every city has 50 to 100 small developers who are by and large under serious pressure. And
sure,
these small developers will start getting crushed, and they'll fold up into the larger developers.
Sure, very 3 quick rapid fire questions. Rupee, 2 months down the line.
Difficult to say, but I would say 72.
72, must be around 72.
I'm saying rupee, you're asking me 2 months down the line, I think likely position of the rupee could be 72.
Alright, rate of interest going forward?
As I said, 50 bips hike between now and the election looks likely.
One last question. Nifty, 2018 December end levels.
I would say 10 to 15% lower than where it is today.
So, do you expect the market to correct from here on?
And market's overvalued. I don't know when it will correct.
Sure.
If people like me have got zero idea about market timing.
So the message to the retail investors is stay on the sidelines and wait for the opportunity and then accumulate.
Message is buy and hold for the long term. There is no way.
Stocks.
Buy great companies, hold them for the long term. There is no way you can do market timing using macro variables or elections and any other nonsense like that.
Sure. Thank you so much, Saurabh, for joining on Ticker Markets and talking to us. We are very grateful and thankful to you. Thank you so much.
Thanks a lot. Thank you. Very good.